Hey everyone, welcome back to the channel. I'm Doug, the retirement guy with all your monthly ETFs. And today we have a deep dive into NEOS's brand new high income ETF, MLPI. This is the MLP and the Energy Infrastructure Ultra High Yield Energy Sector Investment. We currently show a 15.81% current dividend yield. It pays out monthly. It has a tax efficiency of the 1099 structure. And this is a great fund that we're finding out that will actually help add on to SPYI and QQQI as a component to a retirement fund. We're going to show you today, see if this fits a retirement package. Does it fit you? And give you an understanding exactly what is NEOS's brand new fund. Let's get into today's video. Guys, so important notice to everybody, this presentation was designed and provided to you by an educational purposes only and is not constituted financial advice. Educational purpose, no financial advice. Distributions are not guaranteed. The yields are subject to change without notice. And if you need any professional help, if you need questions on the financial stuff, always contact a financial professional. Don't just watch a YouTube video. Don't just ask someone who sounds like they're intelligent with it. Always ask a professional first. So understanding master limited partnerships. This is the first thing we need to understand. Most people have never heard of this. They don't understand it. So we're going to give you a little insight exactly what's going on here. Well, a master limited partnership, MLP, is a publicly traded limited partnership that operates in the energy infrastructure. Unlike corporate stocks, MLPs are not corporations. Investors are unit holders and not shareholders. So the key characteristics is the publicly traded. MLPs trade on most major exchanges like stocks, providing that liquidity and price transparency. High yields, MLPs typically distribute most of their cash flow to the unit holders as distribution, not dividends. And it's a fee-based contracts. Many MLPs operate under long-term fee-based revenue models that provide stable cash flows. So why do we use master limited? Well, most of the energy infrastructure, like gas and oil pipelines, storage terminals, processing facilities, transportation assets, they usually don't depend on heavy oil prices. They get paid based on the volume and the long-term contracts, not the commodity speculation. So that's why they start setting up these MLPs, the master limited partnerships. Now, the other question that gets out there is, how is it different from an MLP, different from a traditional equity? Well, as we told you earlier, unit holder versus shareholder. The tax treatment is pass through versus corporate taxation. Distributions versus dividends. And this is probably one of the biggest ones that we talk about is the tax complexity. K1 forms. What is a K1 form? I want to put it in the simple terms for you. Think of another 1040 form that you have to have filled out. That you're basically a partner in the company. You got to fill out all this information about the K1. So you pay extra to have that done. It's more involved, definitely a lot more work versus just a standard 1099 form of the dividends that you received. Now, generally, most IRAs are not friendly to the MLPs, while the traditional equities, IRAs, are completely compatible. So the fund overflow and the key highlights. MLPI is NEOS's ETFs. It's the newest addition to their lineup of high yield monthly paying funds. It combines direct exposure to the energy infrastructure with the master limited partnerships, or MLP, with a covered call option strategy to deliver exceptional income. The highest yield ETF outside of their non-crypto fund is currently paying a 15.81% distribution yield. So why is it so high? Well, MLPs receive special tax treatment if they distribute at least 90% of their income to its investors. So also they pay monthly distributions, and they give a tax efficiency. Now this is the big thing, because it's under the ETF bracket, and NEOS is actually, you're buying into the ETF who's investing into the master partnership. They report the distributions out at Form 1099, avoiding that K1 tax complexity. So it's a huge difference of what they're doing by adding this into an ETF. It makes it more understanding for most investors and giving us opportunities to generate high income with a little bit more of a stable situation. Look at the yield comparisons over the major ones. NEOS is already walking into a market and aggressively taking over the energy infrastructure with their one fund. When we take a look at what NEOS has done with the energy infrastructure high yield, it's already has $109 million in net assets. It operates an expense ratio of 0.68%. Now you remember, this fund just come out December 18th of 2025. So we're really 30 days, just a little over 30 days into this. And it's paid out 2 distributions so far. So already it pays out about 65 cents and 66 cents. So I'm going to put an average about 65 cents per payout. Now the yield so far, 2.55, that's only over 2 months. So again, that's 1.25. We'll round it up to 1.26 total per month per distribution payout, which is not too shabby. Now it does pay out monthly. Now the fund started off, like you see here, right around that 50, I believe it was right around that 40, almost $50 price share. And then it's bounced a little bit down to 49 up to 52. So it's still finding it, it's still brand new, still finding its way. But over the past month, it's had a growth of 4.44%, including distributions. Year to date is 4.25%. Now, year to date is only 28 days into it. Remember that. And since inception is at a 70.04% total return. So some very strong numbers with this. Now, when we take a look at who they're holding, and a lot of these names you're going to look at and say, I have no idea who they are. But when you do a research on each and every one of these, even deeper and deeper into these, every one of these have a part in the energy sector of America. Most of them are all in the North American energy infrastructure category. And you can see they've broken it down fairly smoothly from as low as 3.2% up to 10%. So they're not heavily into one particular fund or one other area. Now we go back to and explaining this K1 with direct MLP ownership and the exposure investors to a complex tax reporting through that K1 program. This is a critical point. So this is why some people have asked, should I just buy into the energy sector? Should I just buy into these? Well, there's so much tax liability out there that if you have to complete the complex form, if you're late, you got filing deadlines and penalties that you have to pay. And those deadlines can be different from what a regular tax return would be. There's significant costs. If you're having a tax professional doing your K1s, you're talking $200 to $300 per form. And then you get into the whole process. And like I said, generally not suitable for IRAs because of the UBTI rules. This whole thing goes away when you buy into a ETF, especially through NEOS, that are operating as a 1099 system. So MLP's tax efficient solution, what NEOS said is we're going to take away this terrible form that you got to fill out, and we're going to create that 1099. We're going to give you that simple consolidated report annually. We're going to use the standard SEC paperwork format, no additional tax preparations, compatible with tax advantage accounts, and simplify it for our retail investors. This is the thing with NEOS. They're always looking out for us. They're looking out. I want to give them some kudos for this because they're looking how to make our lives simpler and make investments better. And they're not reaching for the moon. What they're trying to do is what works. I'm not promoting it. This is not a promotion or paid promotion for NEOS. It's just what I find with a company. When a company does good, you got to give them a pat on the back. And when people do bad, you got to kick them to the curb. Well, NEOS is one I want a pat on the back. So the dual income strategy mechanism, this is what drives that 15% yield. So the MLP distributions, the high cash distributions from those energy infrastructures that they're paying out like 90% of their distribution to the investors, is generating a nice cash flow all on its own. Okay, that 8 to 10% is what they're estimating it at. I've done some research. I often find it between 6 to 10, so realistically, 8 to 10 is right in line. It is a stable, cash flow driven payout. Now you're going to put in the little unique piece of using that covered call options. So selling that premium income and writing call options on it is going to generate another 7 to 9% across the board. So a total yield is looking right at that 15.81% that we talked about before. So is that a stable number? Realistically, yes. Because majority of it's coming from, I call natural income. So the businesses that are generating income, they're generating it from day in, day out. And then we're only looking at cover calls of covering maybe half of our total yield. So a 50-50 blend. So the fund structure and the index composure to the two. Well, the index benchmark, MLPI's undergoing holdings are drawn from the Mercury North American MLP and Energy Infrastructure Index, which serves as a benchmark for the fund's investment strategy. The company eligibility criteria is geographic requirements. They're staying inside the U.S. and Canadian markets. Okay, they want to make sure that the company that they're investing are listed on the NASDAQ system or TSX or the New York Stock Exchange. They got a cap rate, a minimum, free floating market capitalization of $1 billion. So they're not looking for the little startups. They're not looking for the little innovative companies. They're looking for the big classification companies. Liquidity requirements and business classifications. They want MLP classifications. And with those liquidity, they need a minimum 3-month average daily trading of over 1.5 million. So again, this whole thing is how do they pick their companies is very, very critical to make sure that they can continue doing what we're asking. So some of the key holdings. Now I did show you the top listings, but I wanted to do here some of the key holdings. These are names that, again, people don't always understand. But you have to understand in an ETF, your underlying assets, what are you buying into? Who is it you're buying into? You don't want to just buy a Tom, Dick, and Harry just because they say they're $1 billion. We want to see what's going on. And the first company is TC Energy Corporation, TTE. It's a leading Canadian energy infrastructure company. It has an extensive pipeline network across North America, has a strong record for distribution growth. In bridging, it's a diversified energy infrastructure giant. The track record of the distribution growth and stable cash flow from the fee-based contracts. And then LNG. It's a U.S.-based company that began paying dividends back in 2021. It met the index eligibility despite recent entry into dividend-paying status. Strong focus on LNG infrastructure. That's another big thing that these guys are doing. They're not just putting it all into oil. We're not putting it all into solar. We're not putting it all into wind. They're putting it across the board of multiple different areas and also across different pieces of pipelines, the drilling, and so on. They're focused on the mainstream sector, transportation, storage, and processing. The companies operate under long-term fee-based contracts that generates our income and selects for both yield and resilience to commodity pricing volatility. So that covered call strategy, what are they doing with covered calls? So the covered call strategy, MLPI writes covered calls on the energy infrastructure ETFs, like MLPX. It executes monthly, targeted at the money or slightly out of the money options. And that premium income directly contributes to the high distribution yield. So the key trade-offs, it's enhancing the income of the fund. It does cap the upside. So gains are limited to strike price written options. And the income stability provides that income even in volatile marketplaces. So again, it's another reason why we looked at this for retirement income, retirement portfolios, is that we're trying to eliminate that volatility of the market. We're trying to generate income because that's what we need. And we're willing to give up that cap side to try to generate income across the board. So the strategic considerations preserves long-term capital position by focusing on premium capture. This is similar to other NEOS funds like SPYI and QQQI. So they're using the similar strategies in other funds that have been very successful into a new and market such as the energy infrastructure. Now, risks. We always have risks that we have to talk about. Sector concentration is a high risk because we're dialing into just the energy infrastructure. But I will say this, and you have to say that's high risk because you're into just one sector. But you've spread it out amongst numerous number of companies as well. So I'm not downgrading it. Don't get me wrong. I'm saying single sector concentration are a very high risk. But you have to look at the high risk of how it falls into. Enhanced volatility. MLPs are more volatile than traditional equities. Energy infrastructure exhibits swings driven by the commodity prices and the economic cycles. The limited upside because of those covered calls. And the economy sensitivity. So there are some, other extreme factors as geopolitical can always fall into it, supply chain disruptions, regulatory changes, renewable energy shifts. There's a lot of different things that we can put out there as risks, like with every other fund. But I trust NEOS to have analyzed, because we've already talked a lot about each one of these risks already in the presentation that NEOS has already talked about. So we know that there are risks, and there are some high risks. I want to just make sure everyone understands that part. So a comparative analysis of the energy ETF peers, well, like we said before earlier, this one here from NEOS is really crushing it going forward. Now, yields will always change, trust me. The stock market opened up an hour ago, and yes, it's these things will fluctuate as they go through. But it's the only energy ETF that uses cover call strategy on energy infrastructures. The strategy difference, AMLP and EMLP are traditional MLP exposures without optional strategies. The MLPD also uses covered calls, but on a broader MLP index versus MLPI's sector-specific approach. So you can see that they're doing things differently. So we're not really an apple for apple comparison. We're doing apples and oranges, and we're doing all fruits basically. But you're showing that the NEOS package and the NEOS fund is actually outperforming. So who does this become suitable for? Well, personally, it's ideal for investors with income-focused investors and retirees seeking consistent cash flow. Those wanting tax efficiency exposure to MLPs without that K1 complexity, and a high tax bracket investors benefiting from that 1099 structure. Those seeking monthly distributions for better cash flow management is right there. Who should avoid this? People seeking capital growth or aggressive dividend growth. This is, I always call it the turtle and the hare. This is the turtle in the race. You are not going to see this thing grow your capital. You're not going to see growth across the board. What you're going to see is income. Okay? You're not going to see big dividend growth. You're probably going to see that pretty standard 60-cent distribution. Looking for a portfolio of diversification, MLPI is exclusively in the energy infrastructure. Don't look at this one as it's going to be in all these different markets. Planning to allocate large percentage of your income for this ETF, I avoid that. This thing should stay no more than 10% of an income portfolio. Okay, this is not one that you're going to set it, forget it, put all your money into it and say, here we go, I'm retiring, I'm done. No, this is going to add to your income portfolio, add to more of your, if you've ever watched my videos, you'll see we have the A, B, and C buckets, the security and safety bucket, or B, our income bucket. You're either going to put this in an A or a B. So to me, it's a sector that is going to add and enhance a retirement package. So the investment considerations, technical income tool. Use this as an income tool, not for growth, but just purely for income. This is not a core holding. This is not a high income that makes, valuable income portfolios. It's not suitable as your primary allocation. The risk return trade-off. High yields come with some costs with that cap side. Okay. And you need to make sure you're in a balanced portfolio. A lot of people probably don't have a balanced portfolio with part of energy being a part of it. You probably have the SPYIs and the QQQIs, which is the NASDAQ and the S&P 500 ETFs. Now you're adding energy into this. So it gives you another piece of a puzzle. Is it suitable for investors? Ideal for income investors and retirees. So this portfolio, again, growth potential, limited because of the covered upsides. Income potential, definitely on the higher scale. Is it a risk level? Definitely, because you're into the energy sector only. So I, again, will tell you, is 5 to 10% income portfolio, adding it to it, use as a complement to SPYI and QQQI for a balanced income generation. Consider monthly distributions strategy for that income needs.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.